So, panel number 2 is going to start.
English. The third panel will be again of Deutsch. So please, I welcome all the panelists onto the stage. I'll introduce you, so you're welcome to just take a seat in this comfortable chair over here. First up, I'm introducing Nicoletta Centofanti, who is the General Manager of the Luxembourg Sustainable Finance Initiative, the LSFI. The LSFI promotes and supports the development of sustainable finance in Luxembourg and also drafts and implements, the Luxembourg Sustainable Finance Strategy. She is an environmental engineer and holds an executive MBA from Bocconi University in Milan. She is, I know her well, she is a true sustainable finance expert and has extensive experience also in corporate social responsibility review and implementation with companies around the globe. So she's been in her previous employment, touring companies and making sure that their CSR claims are true. I'm also welcoming Stefan Peters, who is the CEO of the International Climate Finance Accelerator, or ICFA, here in Luxembourg, where he assists fund managers with a focus on climate action to formulate their investment and impact strategies, structure their vehicles, guide operational implementation, and secure financing. No easy job. Previously, and this I found interesting, you ran your own sustainable advisory and investment boutique, and you were also part of the time.org team. Stefan also has experience in private equity, corporate finance, and strategy consulting across Europe, Africa, the Middle East, and Asia. Joining us online is Julia Simon, who joined Finance Watch in January 2021. Finance Watch is an NGO founded upon the request from the European Parliament members in reaction to the 2008 financial crisis. So I'm glad we are being watched today by Julia Simon. Since 2022, Julia Simon has served as the head of research and advocacy. Her work has focused on banking and insurance, prudential regulation, and climate-related risk, among others. Prior to joining Finance Watch, Julia spent 10 years in the banking sector working for the internal audit function, eventually as a senior audit manager. She holds a master's degree in international economics from the University of Konstanz in Germany. Nathalie Roth is the managing director of For Climate, an environmental finance consultancy, welcome, which she founded in 2005 in Luxembourg with a subsidiary in Zurich. Nathalie has over 22 years of experience in environmental finance, ranging from positions in multilateral development banks, insurance, greenhouse gas brokerage, and climate finance consulting. For many years, Nathalie has advised the Luxembourg Ministry of Environment, Climate and Sustainable Development, thanks for the advice, on strategies for its international climate finance program and on carbon markets. Stefan Fahr leads a team of financial stability experts in the systemic risk and financial institutions divisions of the European Central Bank. The team develops the ECB's monitoring framework for climate-related financial stability risks. He joined the ECB in 2007 and has extensive experience in research, monetary policy, and macroprudential policy. He holds a PhD in economics from the European University Institute in Florence. Welcome. It is a great pleasure to moderate this panel of experts. I'm really looking forward to the discussion and then also the discussion with the audience afterwards. So to provide some context, previous keynotes and the morning panel, there we set the broad framework and touched on the big questions. Now we will use the example of climate finance, adaptation and mitigation to further exemplify the state of work of the green finance agenda. So we'll be more specific here. Many initiatives and the first major ones in the field of green finance had a climate focus. We mentioned this morning. So for example, the CDP, TCFD, TNFD, Net Zero Alliance, etc. I like all these acronyms. The EU taxonomy has so far been spelled out for only 2 of the 6 environmental goals so far, climate mitigation and climate adaptation. So we are quite advanced in this regard. There are 2 EU climate benchmarks, the EU CTB, the Climate Transition Benchmark, for decarbonization paths, and the EU PAB, the Paris-aligned benchmark for compliance with the 1.5-degree target. So the data situation in the climate sector is qualitatively and quantitatively the most advanced. This is probably due to the fact that CO2 and greenhouse gas equivalents is a standardized unit of measurement and is available as a basis for indicators for control and evaluation. So we're coming from a pretty good baseline. So I prepare to be wowed what we are doing in this regard. I'll start with you, Nicoletta. You have a lot of experience working on carbon markets. For a long time, the CO2 certificates of the EU ETS were too numerous and too cheap. Gradually, we seem to be approaching a price that has more of a steering effect. In addition, with ETS2, we are expecting to bring more sectors into the scope of the trading system. My question is, how do you see the future of carbon markets in the context of efforts to bring financial markets onto the 1.5 or 2-degree path?
Thank you, Claudia, for the introduction and the very good question, and allowing me to dive into the subject of green finance from the angle of the carbon markets. The carbon markets have a long history of 20 years now, with mixed results, with positive and benefits, so challenges. But nevertheless, what the carbon markets have achieved is giving a ton of CO2 a price. We have previously in the panel heard also from André Weidenhaupt, the internalization of external costs is important, and that's something that we have been able to achieve with the carbon markets, giving carbon a price. When carbon has a price, you can start to integrate it into financial structures. You can then help to channel funding to activities which would not have had the opportunity to receive funding before. But I don't want to give a large overview of the carbon markets, but generally you have to distinguish between the compliance markets, the cap and trade, emission trading markets, and the more independent, voluntary baseline credit markets. It can become quite technical, so I try to skip that. But what we have to keep in mind is under the compliance market, the cap and trade market, you fix the cap and you give allowances, people can trade allowances. It's an economic efficiency instrument. It's a regulatory instrument allowing to reach a goal with the highest economic efficiency. And on the level of the voluntary markets, you basically enable to steer finance into activities that would not have taken place otherwise. So this is the key distinction, and that's also why we have different prices in the compliance market and also compared to the voluntary market. People sometimes speak about one general carbon price. They refer to prices in the compliance market under EU ETS. When they want to develop a project in Senegal, for example, it's not possible. So you have very different prices in different markets, and that's important to keep in mind. We have had the Kyoto Protocol established both compliance and voluntary markets. We had briefly after the Kyoto Protocol that the big compliance market, the EU ETS, was established. Since 2005, we have several phases now of the EU ETS. So with the too low prices you refer to, finally we have established elevated prices on the EU ETS. That's the result of a long series of actions from the Commission to really reduce the number of allowances, also reduce in the future the number of free allowances. So finally we have a price of 85 today, with a future price in 2030 that's currently traded at 113. So we expect price increases also in the EU ETS. Compared to that, we have prices for the voluntary carbon market, so prices for carbon credits in developing countries which can range between a couple of dollars or euros, 3-4 euros, up to 40 euros, sometimes even more when we have good removal projects. So there's a large variety of prices and understandings. But as soon as you have a higher price, you kind of it will shift. You can shift the decision making towards investments which would have otherwise not been done. So and with that is also you can then steer also financing to such investments. So the right price really matters to that respect. You also referred to the upcoming EU ETS 2. which includes then also the building sector and the transport sector, and which will run in parallel to the EU ETS that we currently have. And it will also have other prices, so because you cannot have, for these sectors, they affect households directly, people directly, so there will be separate prices, also with price stability mechanisms. For example, if the prices will go above, I think, 45 euros, they will release more allowances to this new system. So we have talked this morning about social dimensions of regulation. So these are also included. And just one more minute to explain where we're also heading under the Paris Agreement. The Paris Agreement, of course, has given us an entire new infrastructure when it comes to carbon markets than we had under the Kyoto Protocol. So we also had to shift, many players had to shift their minds, because especially when carbon markets are concerned, the Paris Agreement does not allow, for example, anymore the claiming of carbon neutrality or using carbon credits to claim as offsets to claim carbon neutrality, because if you do a project in Africa, this country in Africa has also a goal under the Paris Agreement, and it has to establish an inventory. And if you would export the reductions that you achieve in Africa to use it in Luxembourg, then you would need to have that corresponding adjustments in the inventory of the host country in Africa. This is currently, it's planned, but it's not yet happening. Maybe it's happening in a handful of countries who can do it well, or can do it already, or do it if they're doing it well, it's another question. But can do it, so this corresponding adjustment is still difficult to get. And that's why many of the voluntary carbon trades will not get in the near future a lot of corresponding adjustments, so they cannot claim carbon neutrality, or the user of it cannot claim carbon neutrality, but instead we are seeing that they're starting to claim impact. So they claim that they have helped this specific country in Africa to achieve its nationally determined contribution, so its climate goal. So it's more like an investing for impact, which I see developing at the moment, and which is, of course, very much also in demand, also from actors which now fall under the different disclosure regulations. So now we'll stop here. Sorry for the long
No, thank you so much. I mean, I have follow-up questions that I will not ask. I'm just saying that, you know, we're touching here on a subject we talked about in the morning panel, which is about avoided emissions and all the different definitions, virtual, real, etc. Then for carbon offsets, it's the same. I mean, and it just goes to show that in sustainable finance, we need to develop and really have an expertise on so many different subjects, which makes the topic so difficult. But go ahead.
May I answer?
Yeah.
Yeah, I mean, exactly. The avoided emissions is an important example, but the carbon markets have dealt with avoided emissions since the beginning. Many of them are based on avoided emissions, and well, on emission reductions, if the entity had already emissions, but often it's avoided emissions, and it really depends on where you then put the boundary of your avoided emissions calculations. What is the baseline, to make sure that the baseline takes into account all the future actions, policy actions that you know of today, and that the baseline is dynamic. So you cannot have a static baseline, not taking into account the national context. So, and that's the difficulty about establishing good baselines. And that's sometimes the markets are quick and want to do quick calculations, so you have a baseline setting which might not be accurate enough, but we need as well this quantification of avoided emissions, especially if we want to invest in climate solutions, because investment in climate solutions often entail higher scope 1, 2, 3 emissions of the solution provider, but the solution provider through its offering helps to achieve and enables achievement of a reduction on the level of society. And that's what we want to capture, otherwise we don't have enough money going into investments of climate solutions.
Yeah, I think you're right, and I think sometimes a lot of that money that you get from selling carbon offsets is actually used to finance solutions that have a positive social impact as well. Right. So for some of these investments, it's the only income stream that they have and
Yeah.
to claim. Yeah.
And then, yeah.
Nicoletta Centofanti. So let's move on to Luxembourg. The LSFI did a Paris Agreement Capital Transition Assessment, PACTA analysis, last year with interested financial institutions in Luxembourg. What were the results and where do we go from there?
Thank you, Claudia. Thank you for inviting me today. So just a few words on PACTA for the ones who doesn't know. They're, of course, a knowledgeable audience, but PACTA is a methodology that has been developed by 2DAI. So Jacob was one of the mind behind PACTA. You've heard about him before. And it is a methodology that helps financial institutions measure their alignment towards the Paris Agreement goal. So either loan books or investment portfolios. We decided to use this tool as it was one of the first activities that the LSFI coordinated with the technical support of 2DAI. And when we ran this analysis, the exercises, we decided to make it voluntary and it was confidential. So we actually don't know who are the institutions that participated unless they told us. But we know that 48 financial institutions did it, as well as 4 banks. So PACTA can be performed either by banks or by financial institutions that have an investment portfolios. So we had insurers, service providers, as well as fund managers. So to really try to get some results and some insights from this analysis that, as Claudia mentioned, we published an overview report in 2022, in March 2022, and here we really explain the methodologies, the different timelines, the objective, and we tried to run an interviews with 4 interested financial institutions, as well as a survey. And basically we learned that from participants that for PACTA for investor, they found the methodology pretty straightforward and easy to use, whereas banks struggled a lot and didn't have the insight that they were expecting. We understood that PACTA works well with big banks, but with banks based in Luxembourg, lending money in a smaller country is a bit different to gain insights. Another very important insight was that, in fact, those financial institutions use the methodology for the reason we decided to launch the program, so to upskill themselves and to take decisions on their ESG strategies and to see whether the measures that they were putting in place were successful. So finally, we were pretty satisfied with the outcome of those interviews and the survey, but we realized that we should do a step further, and we should try to complement PACTA with possibly different tools and methodology.
Thank you, Nicoletta. So, Stefan Peters, I've had the honor of taking a look at all of the funds that ICFA has supported. You help beginning asset managers launch products to help achieve climate goals. What can you tell us about your work? Is there a lot of interest from developers? Is there a lot of interest from buyers? And what are the challenges or problems you've encountered?
Thank you, Claudia. So maybe just a bit of background as well on the ICFA itself. So essentially, we are a non-profit association. We provide financial support, training, coaching, and access to experts that help our fund managers that are in our program to tackle all the challenges they have to actually get their fund up and running, essentially. We've been running now since 2018. We've accelerated 6 cohorts and currently selecting the 7th cohort. That is a total of 28 fund managers that we are actively supporting and helping. Together, they are raising or targeting to raise almost $2.5 billion to be invested into climate action. And that can be companies or projects, depending on what strategy they're using. Of those 28, it takes a little while to fundraise. So our earliest cohorts now, 6 of the fund managers have actually gotten commitments from big institutions, amounting to almost $930 million. So as they now have these commitments, they're drawing that capital down and are finally starting to invest into the projects and the companies that are really going to make tackling some of these climate challenges themselves. Over the years, we've had a steady interest in the program itself. We're tackling a market need that is clearly there. A lot of our first, second-time fund managers struggle to really deal with the administration, the financial investment they have to do, as well as just the regulatory and compliance that comes with setting up a fund. What we've noticed this year is that we were on a watershed moment, essentially. We've actually seen 3 times as many applications this year of projects come to us asking for support to help them set up their fund so that they can start actually deploying capital into climate action. Likewise, on the other side, we're also seeing, of course, a lot of LPs and a lot of investors looking at these fund managers and being interested in investing into them. But there is a bit of an issue here, a mismatch in a sense, because the big asset managers, the big pension funds, insurance companies, they're looking for stable returns, stable team, in a proven investment strategy. And if we're talking about climate, some strategies are very much well proven and you've got the data. We're talking about renewable energy, for instance, but there's a lot of other types of strategies out there that simply don't have that historic background and that doesn't have that track record, essentially. And that's where there comes a bit of a mismatch between, having these fund managers come to the market and say, we need to raise 50, 60 million at least to have a viable fund. And the only way that they're going to get to that target is actually targeting the institutional investors. And institutional investors are basically saying, very interesting, come back in 3 years on your second fund, essentially. And that's something that we're trying to solve for the fund managers, but also just in general, the climate finance industry is really making sure that we can cross that valley of death, essentially, that they're faced with, and helping them not only, leveling up the fund managers by making them ready to deal with institutions, but at the same point also kind of pushing and nudging the institutions a little bit to say, maybe it's time you also looked at some more innovative climate solutions, because what you're doing now is not quite enough, right? We see the public institutions put a lot of capital into it, but that's not going to shift the real balance about what we're doing with the climate challenges that we're facing. We need private capital to also play along with this. So that's sort of roughly what it is.
Thank you, Stefan. I hope that our partner countries here, Germany, Austria, Switzerland, Liechtenstein, are listening, because I find this really worthwhile initiative, and it's showing us that, your work is very important, because the taxonomy, consumer demand, everyone is pulling the finance industry to invest in these kind of vehicles, but they are not yet. And at the same time, it's very difficult for these beginning fund managers who are, these are true impact funds, and I think involved mainly in Africa, South America, Asia. So you're making a real difference to actually access that money. And so I'm glad you were there to make this connection and hopefully have the money flow in the right direction.
But if I could just add one thing. So it's a bit of a race that we're always looking and catching up with regulatory affairs as well. I think 2 years ago, the rule of thumb of having a viable fund up and running was 50 million. Last year, the rule of thumb was 60 million. Now we're looking at 70 million of AUM to cover the cost. So the barriers are creeping up, especially for the innovative fund managers out there. It's all kind of concentrating to the established ones who have the scale to deal with the regulatory demands, the compliance issues that come with it. And I think that's something that we should be looking for some solutions to create these pathways, because the innovative projects also need to come to the market, or else they'll never reach that scale. They'll never be able to do a proof of concept.
Okay, so this is the flip side of having good regulations, is the regulatory burden and the cost, and kind of excluding these kind of innovative funds. I have a question to the other Stefan on the panel, Stefan Fahr. In 2015, the global community set a goal to limit global warming to 1.5 degrees. We heard this morning that this is going to be difficult. Obviously, this is not news to us. What goes through your mind when you think about your job at the ECB? What challenges do increasing physical and transition risks pose for central banks?
Thank you for having me today, and thanks for the question. Indeed, the news about that we might not reach the goal of 1.5 is a bit of a kind of, many expected it, no? And we know. So the question becomes, is this a failure of the models? I don't think so, but is it rather a failure of the implementation and the incentives that we had seen also on the slide before? So what does this imply for me at the ECB doing climate monitoring or monitoring risks of climate-related factors for the banking system and the financial system overall? Well, first of all, the physical risks will be more intense, more often, more frequent. That will be one obvious consequence, and we need to monitor that and to assess how kind of these risks then materialize and transmit to the real economy, where kind of damages are then we have damages in the real economy, but also then subsequent elements in the value chain that will make the economy no longer go as round as we think. But then there's a second part of it, which is the finance part, or the financial system part. Also, the financial system and banks will have losses. And we have two questions there. Are these potential losses then sufficiently kind of absorbed? Is the banking system or the financial system sufficiently resilient? And the second part is, are these risks, and here we come back to an earlier intervention, are these risks adequately priced going forward? No? So one needs to develop credit risk modeling, adjusting those for that. And once we have the individual risks from these physical risks, there is another element which regards the system, which is namely that there is, because the banks and the financial system is interconnected, we may face contagion on certain factors. So that was on the physical risk side. On the transition risk side, what we are also moving towards is more of a disorderly adjustment, rather than, as the NGFS has, orderly, disorderly, and hothouse world scenarios. We might not be able to have this fully orderly, this transition fully orderly, but rather kind of have more rushed implementation, or more kind of at specific moments seeing kind of ruptures that might occur. So what happens in those moments? Well, what can happen is that asset prices suddenly move by a lot, and this obviously needs to be kind of also absorbed by the system in some form or another. Hence, it will be important to develop the scenarios so that they reflect really those risks that can be assessed from the information, using the information that we have now, using the forecast models. That will be one thing. We also would like to see that the standards for measuring climate risks are implemented more swiftly. We have the TCFD you mentioned and the ISSB. They have a plan. We should stick to that plan. And last but not least, obviously, the adequate regulation should come into force once both on the microprudential side as well as the macroprudential side, meaning to have really the individual institutions being resilient, having the right incentives to finance things, and last, to be ready with the system using macroprudential tools.
Thank you, Stefan. I want to pose a similar question to Julia Simon. It's about physical risks again. How high do you at Finance Watch assess the exposure of European banks to such risks, not only against the background that the European financing architecture is bank-based, and what is Finance Watch's position on this?
Thank you for the question, and good afternoon, everyone. Thanks for accommodating the hybrid format for myself. I think I can't concur more with my previous fellow panelists to say that we are looking at the picture holistically, and probably I will hardly be able to give you and answer more quantitative and specific in terms of what is the actual physical risk exposure of the European banking sector. I think we are really very carefully looking at what the ECB in particular is doing in terms of their monitoring of the physical as well as transition risks to understand how this might affect the system. And I think my point here would be kind of a very big point of caution on the element of trying to nail it down, meaning measure it very, very precisely. We've been looking what the ECB is doing in terms of trying to understand, as the previous colleague said, the transmission channels, also seeing that for the precise understanding of all the physical risks, not only like direct, but also throughout the supply chain of in the economy, we still have a lot of data missing. Right, we have certain indications, and like the current work is delivering a lot of insights, but still we also have a much bigger indication than the more kind of unknowns we uncover, the more unknowns we still see ahead of us. And I guess here an important element that at Finance Watch in terms of our position, like that we are always drawing our attention, like the attention to, is this systemic element of this whole story of interdependencies and possible contagion effects in the economy, which means that we are able to understand the so-called chronic physical risks well, so we see them slowly coming, we kind of try to measure them, but we are also seeing that either the unmitigated climate change or also the disorderly transition bring with itself a lot of stories where we are not properly able to say what will happen if, right? If there is a lot of disruption in the economy due to physical events, this might cause also migrations and contagion effects between different financial institutions, regulated as well as unregulated. It might call this whole kind of fire sale dynamics and changes in the asset prices. And this is where probably all the nice models that we have in place now to run our economy and the banking system in the business as usual will fail to depict and capture all of these effects. And this is why from the Finance Watch perspective and what we actually call for once we go and speak to the events like this, once we go and speak this to policymakers, is the need to change kind of the paradigm of thinking about the risks as we are used to in all the other financial risks we are usually managing and monitoring, meaning we need to shift from waiting for the perfect data to be there, to model and measure it, to agreeing on the fact that we are facing a situation where we all not only have the risk, we also have the radical uncertainty. So means we are agreeing that we are not able to perfectly predict the events that will come, but we are most certain that they will come, which means that we need to be forward-looking in our regulation and we need to be precautionary in our regulation because the financial system, the banking system is not an exogenous factor to this whole of the system, because with the financing that the banks provide to the economy, and you rightly said so that the European economy is very bank driven, or the bank financing plays a very important role compared maybe to some market-based economies. It is very important to consider that banks, with the provision of their financing, they influence a lot of activities which happen also in the real economy. And this is why we need the congruent and simultaneous actions, prudential actions, also on the banking side, to make sure that we are addressing these risks and that we are making sure that the banks, they play their role in the story, that they are also resilient. So this means that we also have to have adequate capital requirements on the micro as well as macro prudential level, as was already mentioned, as well as use their available tools in terms of their own risk management to make sure that sustainable investments or transition efforts in the economy are also appropriately facilitated. I'll make a stop here.
Thank you, Julia. So while we have our expert from the ECB here, I want to ask you again on some questions that came up in the morning as well. So Stefan, can you tell us a bit more about what is happening when it comes to climate stress testing? What do you do? Do you have data on banks that are not covered by the climate stress testing? And then a question from this morning, how is it going in terms of nature-related financial risk? is there any headway the European Central Bank is making there in terms of their stress testing?
What was the last point?
The last point was, so this morning we spoke a bit about nature-related financial.
Yes.
Yeah.
So as regards the stress test, there are kind of, we approach the banking system in two ways. One, as we call it, the top-down, and the other one, the bottom-up, also kind of to the joint supervisory teams that have constant interactions with the banks. So when one goes for the bottom-up one, up until now it has been to really see how is the risk management of climate-related risks done at the banking level. What indicators do they have? Have they implemented, especially from the TCFD, the various recommendations, and where do we stand? And there have been two publications on that this year and last year. That last year still. This was covered relatively poorly, but for this year there has been a great leap forward in terms of implementing good practices for the work. Regarding the top-down stress test, how do we do that? Is we develop models in order to assess credit risk based on certain characteristics, given the exposures of the banks, and then we kind of have also kind of either at fixed balance sheet or as a dynamic balance sheet, we then consider what are the implications over time of these of certain risks and adjustments in terms of credit and climate-related credit as well. So these are the two major approaches. The question if banks in this top-down one are covered or not, for which we do not have data, well, no, because we don't have the data sufficiently granular to run it. What we can do is to run a macro model, but this is already set. With a macro model, but this is already different. As regards the second part of the question, the nature-related analysis, we are, so I've been working in what we call the project team of climate-related risks. That is a project between the ECB and the ESRB involving all national central banks of the EU and beyond the members that are part of the ESRB. And we are also, like this conference, in the fourth year. So in this fourth year, we have one part dedicated to nature and nature-related financial risk in order to, at the conceptual level, so to say, how do we do this link? How do we go forward? Unfortunately, there will be kind of soon, for the summer, a short blog on this, on what is exactly done there. I'd like you to wait for that before I say something. And then the rest of the report where stress testing and monitoring is done is then published at the end of the year. But we had in the previous years as well those reports. Thanks.
Okay, thanks. You sure you can't share the results now? So one of the topics I want to talk about is this discussion between the green supporting factor and the brown penalizing factor, or basically incentives for climate finance and disincentives for fossil fuels. And I want to open up this question to everyone on the panel, because what do you think, when we had this discussion, it looks like we have now sort of focused on the green supporting factor, but what do you see happening in Luxembourg and abroad when it comes to this discussion, and what is your opinion, and which is better, which will get us to the Paris alignment more quickly? In a sense, it mirrors the question we just had before the break. I'll look at you. Yeah.
I can start, and maybe the colleagues can join. I would like to start with the easier part, the green supporting factor, which is basically an area where also Luxembourg is quite active in supporting in different ways with public finance, with public funds as well, to projects or activities that are green and want to deliver results. So public spending can be done on the level of helping projects in the preparation phase, in terms of feasibility studies, etc. This is mostly done, unfortunately, by now in developing countries with the international climate finance funding, but you can also use public funds to guarantee some of the risks, or to put as a first loss layer in different structured funds. There is the ICFA, the expert entity, using that. And so you can do a lot on supporting green finance, but in the end, it's my personal view, if the underlying prices are not right in the green activities, so if you cannot generate enough revenues by the green activities themselves, if the risks are too high, you cannot channel finance on the ground. So, and with that comes the whole discussion, is the regulatory framework on the level of the activity, or Andre also talked about market-based regulation, penalizing based regulation. So is that correct? And don't we have obstacles there to eliminate first? And what about also still hidden interest, or and harmful subsidies, which are still a block to further advance green finance? And we cannot channel finance unless this is tackled, because finance is only a mean to reach a goal, but it's not a way in itself. So that's something I would like to discuss with the panelists as well, and that's my view.
I think you're... one of the issues, of course, is when we have a penalizing factor is the issue of leakage. So you can have rules here, but investments will still come from elsewhere in the world. Anyone else want to, and I'll say one more thing, I presented it as a sort of either or, but ICFA is a case in point that you do still need support even entirely on the green side, right? Because it's not as simple as, having the regulatory framework and then the investments will just flow. But there are, certain issues that ICFA is addressing. But let me open up the question again to everyone on the panel.
Well, just on your point as well, I think what we're seeing obviously is that there's a lot of support coming into funds and solutions from the public side that would do first loss capital tranches, or more as governments, DFIs, foundations stepping into a junior tranche, so that they can actually attract more private capital coming into these funds as well. So there's a clear aspect of, there's a support that really works. And there are some challenges there as well, of course, because there's a long timeline to obtain these type of kind of junior or kind of de-risking elements of capital. But when they are there, typically they do work very well. And yeah, on the penalizing side, I'm no expert in that sense, but I think what we've seen with the carbon taxation that we've seen here in Luxembourg being implemented, it already included some learnings that we saw from France, where obviously the Gilets jaunes had a counter effect. So keeping in mind that obviously penalizing factor, most of our economies still drive on fossil fuels. So if you're going to do a penalization on any of these factors, it's going to trickle through our economy and probably hit the most vulnerable communities the first and the hardest. So that's something that we should really always take into account, really understand who are the real stakeholders of all of these elements, and make sure that we actually counter the negative effects they might be experiencing, making it basically transition that is just and equitable, if we really want to use the buzzwords, but that is what actually should be taken into account.
May I jump in?
Yes, exactly. Yes, I was going to ask for your take.
Thank you. So I guess like when we speak about the two also quite acronyms that have become buzzwords, the green supporting and brown penalizing, I would clearly differentiate kind of the two streams here, or the two different types of measures that are usually discussed, and I think we're a little bit kind of putting them into one, whereas there are all the different types of incentives that can be created for the green, sustainable activities, whatever you define them, as well as all the different types of subsidies which can be or cannot be given to them. In the broad realm, right? This can be public finance, this can be different sustainable finance initiatives, anything which is out there, different types of support. And there is also a string which is financial sector prudential regulation, right? The regulation which speaks about the risks and which usually has to do, or not usually, which serves the purpose of ensuring that financial sector is stable throughout the whole economic life, let's say, right? And this is, I think, the crucial difference here is that on the side of like non-prudential, we can, of course, governments in their role of kind of guiding the economy, guiding the society through the times, through the transition, they can come up with different types of measures. They can be publicly financed, et cetera, which are just in there to create incentives or like correct some market inefficiencies. For example, carbon price, I think, is an undoubtedly like useful measures which should be like worked on and which the role of which should be increasing. At the same time, if we speak about the prudential regulation, it's very important to keep in mind, again, the main purpose of it, which is the financial stability. And here, like what I would like to kind of speak in there, because we work a lot on this topic, I think it's very important not to jeopardize this main purpose, right? So to keep the prudential regulation as it is risk-based, because if the financial system is not stable, it will not be able to anyhow support the economy, and it will only amplify like the different types of disruptions which come with the climate, related either the transition or the events. So here we have the situation at the moment where climate risk as such is not priced at all. Well, I would say not priced at all. Of course, there are some maybe starting attempts to correct for that, but status quo is that the climate risk is not part as such of the prudential framework because it has never been considered or recognized that much, right? So at the moment, the types of financing which are actually contributing to accelerate climate change, in particular the fossil fuel related financing, does not have this climate-related risk priced in the prudential framework, partially due to the fact that we have not been able to precisely measure it, to put a tag on it, because we don't have the full data, because we have not seen the kind of materialization in the past that we are now agreeing we will see in the future, the keywords tipping points, again, nonlinear developments, right? So there is a need, first of all, to recognize this risk into the prudential framework. And sometimes we hear saying this brown penalizing factor, the words that we've also used right now, like we are very strong to say that this is not a brown penalizing factor. This is basically bringing prudential regulation to its actual purpose of recognizing the risk. Because while this is not happening, all the other activities which are sustainable or which contribute to making the world more sustainable, they are automatically at a disadvantage, right? So we really need to correct for this before we can say that we can just reduce some prudential requirements to incentivize the transition. Of course, we could do that because relatively those other activities are lower risk, but it doesn't mean that we can simply relax the requirements to consider that, because we are basically putting the financial stability or the risk considerations in jeopardy, right? So first of all, we need to correct for that, not penalizing, simply correcting, and then we will have at least the status quo. And of course, I will not talk about kind of the rest of the things like direct fossil fuel subsidies, et cetera, which also has an important role to play. But in my kind of mandate here as Finance Watch, also with the view to the financial stability, we think this is really critical. And what it means to recognize the risk into the prudential framework, this would mean bringing in the appropriate prudential measures. From our perspective, the first prudential measure which can be done based on the evidence which exists are correcting for the capital framework. So meaning recognizing the risks which are in particular associated with the fossil fuels, because the destiny of this is very clear, and climate science tells us that the continuous consumption of fossil fuels is incompatible with yeah, to a degree, 1.5, I think we all agreed we can forget about it at all, is incompatible with any kind of climate goal alignment. So we really need to make sure that the risks which are going forward in there, and this will be either the transition risks, because those activities will become less and less profitable as we are transitioning, and we are already seeing some movement saying that European Union is managing to reduce the consumption of fossil fuels, discussions which go along the lines, so what will happen with the whole infrastructure, whereas people like to say, oh, it will be used for the renewable hydrogen, and the engineers go to say, well, actually, this is not true, right? So all of this is kind of accumulating the pool of stranded assets, meaning the financial risks mounting on the balance sheet of the financial institutions. Or if we say, well, actually, we still need fossil fuels and like we'll do it later, we are also increasing the risks of disorderly transition. Or simply, if we are giving up on the transition, we are in the scenario of major climate-related disruptions, and then the losses will be evident. So this is an important thing. And the other kind of set of things which could be done is a very well planned and executed transition, for which we need, of course, also the governments to play and implement appropriate climate policies. This is where finance cannot go alone, but finance also has to align its operations with the goal of, with the climate goal, again, be it the 2%, probably the 2% if we are still having any hope.
2 degrees. Yeah, thank you. I think that mirrors what Natalie was saying, that sustainable finance is not the end goal, but a means to an end, which is a planet we can all live in. And thanks for your point on language. It does matter. So if we start talking about the brown penalizing factor, then we're immediately starting on the back foot. So it's just correcting or internalizing an externality. So thank you for that. Nicoletta, just coming back to Luxembourg, what do you think are the next stages for moving forward towards Paris alignment of the Luxembourg financial system?
Thank you, Claudia. So as I mentioned, we started with this climate scenario analysis with the PACTA methodologies, but we realized, so to say, that to reach net zero objectives, financial institutions have to follow 5 steps. So they have first to measure their emission, they have to identify a transition pathway benchmark, they have to set targets, they have to take actions, they have to disclose and monitor progress. So to really try to tackle all these steps, we decided to put in place a working group on climate measurement and reporting. I have here in the audience our co-chair Michael and our member Natalie with me in the panel. And here we are asking advice to this working group members to really tell us, advise us on which combinations of tools and methodologies could be used to help financial institutions. Because, of course, to reach the Paris Agreement goal, tools like PACTA signal where we are heading to, but we really need the financial institutions to take not only commitments, but real clear targets validated with the existing methodologies to then reach those objectives. So to complete, basically we are waiting, we're looking forward to the conclusion and the outcome of these working groups that will hopefully come before the summer. And then together with the board, we have Christina and Claudia with me today. We will hopefully manage to define which methodologies together with PACTA will be finally implemented with the support of course, of the Luxembourg Sustainable Finance Initiative.
Thanks, Nicoletta. And let me advertise over here for the LSFI newsletter if you haven't signed up yet. I think it's very well curated, so you get really good feel of what is going on in terms of regulations, in terms of events, for sustainable finance in general. So I had a discussion with someone over lunch breaks. It's a great source of information.